Welcome to the Wealth Matters podcast, where investors come together to better understand how to build passive cash flow and create generational wealth without all the confusing mumbo-jumbo. Here's your host and co-author of Amazon #1 bestseller, Alpesh Pamar.
Welcome to Wealth Matters podcast. I am going to talk to Mr. Dani Beit today. Dani's got over 18 years of experience investing in US real estate, so I can call him a veteran for sure. And he uses his knowledge and experience to secure financial growth for beginners to experienced investors. Since 2004, Dani has worked with many hundreds of investors on close to 5,000 transactions, helping them to build strong real estate property portfolios by investing in various US metros. Welcome, Dani.
Thank you for having me. Thank you for the intro, and I'm just pleased to be here.
Absolutely. Tell us something funny or interesting about yourself.
Something funny or interesting. Funny, I don't know if my wife would agree with that. She's the funny person in the family. But the one thing that I always kind of think that people find interesting is that I'm originally from Israel, and I served 3 years in the Israeli Special Forces.
Oh, really? Mossad?
Yeah. Nope. Military. Military
Okay,
Special
military.
Forces.
Okay,
Yeah.
got it.
Yeah. By the way, even if I was in the Mossad, I will tell you.
Right, exactly. Yeah. That's
So
why
you
I was
never know if I
recording
just-
this.
Yeah. Definitely not Mossad.
Yeah.
Not Mossad, no. Military. Yeah.
That's great.
Yeah.
So then when and how did you start investing in real estate?
So I started back in 2002, or actually there was probably around 2000. I started realizing as a engineer by degree, young adult starting his independent life after the military, after getting my degree, already started working for the Israeli high tech, actually making good income. And I realized very quickly that I felt completely illiterate when it comes to real life finances, right? What am I paying and what is my taxes and what shelters they have. And I went on a 2-year quest to teach myself about everything, everything related to like home finances, personal finances. I was completely ignorant. And that path that's put me on learning the different finances led me to start saving up and led me to start looking for investments. And I probably dabbled with a little bit of options and stocks for for 6 months to a year. And I wasn't happy with the risk rewards.
Right.
And I was on a personal quest. And that quest was, I need to better my life. I don't want to be on the path of, working for 10, 15, 20 years like my parents and other family members and have nothing really to show for all this hard work. And I found out about while in Tel Aviv, about US real estate. And when I found out and researched that, it took me, quite a long time to kind of get a better grasp of it. I just fell in love with the whole idea, and that's where I got the bug, so to speak.
Right.
I bought my first rental, sight unseen. Me, some young guy in Israel. Nobody around me is doing, real estate investing. No, Google was a startup. 2002. No Zillow, no Trulia. Not all those amazing tools that are at our disposal today. No bigger pockets. No podcasts, so to speak. And I bought my first rental completely sight unseen, completely remotely outside of Phoenix, Arizona. And that was an amazing, it turned out to be probably 10 times better than I expected.
That's great. Hey, so I started laughing when you mentioned stock and options because I started the similar quest, but of course, way after you in 2013. And 2015 is when I was actually doing options and futures and whatnot. And just in 6 months, I realized exactly same thing, risk versus reward. And my time, I think, people forget when they talk about ROI, they forget ROT is as important as ROI, return on your time invested. And
Yeah.
I was just always busy trying to look at my stock screens, right, all over, all the time, and I realized that this is not for me. But
Yeah.
that's why I was laughing. So where are your investments right now?
So we're scattered in multiple U.S. metros. It's been, I've probably had a a footprint or some activity in more than, over the years, in more than 50, probably even more than 60 different US metros.
Wow.
Not in all of them I've owned myself. In many I did. So I kind of changing. I'm selling. I have, two properties that I'm selling right now as we speak. Two that I'm selling. So there's always there's always something going on. So it's multiple US metros. Primarily, I always love the Sun Belt. The southern states, the warmer south. That has been most of my activity. I've been up to, let's just say, I've been up to Chicago as well, but that was like, a sphere. But usually, I like the warmer weather.
Yeah, I like Sunbelt as well right now. Yep. So how do you pick markets for yourself?
So I have a very clear formula that I've been, exercising for many years, and it's first of all, it's like I said already, the Sun Belt is my preference, but it has to be the size of the metro. Usually has to be about population wise 1.5 million and more. It has to have multiple big employers present, showing growth in populations and jobs. That's kind of the indicators for the metro. Ideally, states that are landlord friendly will definitely help. Ideally, stay away from harsh winters. I learned it the hard way.
Me too.
Yeah, that's actually something that I added to my formula maybe 4 or 5 years ago. I never had it specifically because it was anyway there, but I actually officially added it. So it's not that there are no winters, but harsh winters, stay away. And then once I decide on the metro, then I take it down a notch, and I just start seeing what can I, in the middle class sector type of schools and areas, how much, what are the purchase prices, what are the rents, and actually analyze and see what can I get for it.
So which markets do you prefer right now in
right
2021?
Now, yeah, absolutely. I'm very keen on DFW, Dallas Fort Worth, Nashville, Kansas City, St. Louis, and Birmingham, Alabama.
Oh, okay, awesome. I like all those markets. I'm not more on the Kansas City and St. Louis side because again, it's Midwest, and I had decided that I'm not gonna do anything. But yeah, I am. I love Birmingham. That's my, one of my big markets there.
Nice.
And of course, DFW it's always, as always, it's awesome. So let's talk about, because when you and I were chatting, you said that because you have seen this for close to 18 years, what are some of the most common mistakes investors make?
So I want to tell you about two that I think that are just at the top of my list. The first one is the 1% rule, everybody thinking they're following, which, am I allowed to curse on this podcast?
No.
Okay.
But good. I know who you are going to refer to. There are some of the
I wasn't planning to curse anyway. I was just saying, like, come on. The 1% rule, let me put it this way. I used to follow this rule up until maybe 7 years ago. That, like a rule of thumb, right?
Yeah.
I made a huge mistake. I went to and explored Nashville maybe in 2013 or 14, and I used the 1% rule, and it didn't work. So I left. I came back 2 years later. I said, this time I don't care about the 1% rule. I'm gonna take Nashville. And I took 9 properties from different parts of the metro, and I completely ran them through our financial model, analysis model, which I used, everybody's using in our ecosystem, the agents, myself, and I ran it through. I did not get the 1%. I only got the 0.75%, but 0.75% back then in Nashville. And I say Nashville, I mean the metro, not necessarily the city.
No, okay.
Generates a higher cash flow than 1% in Dallas.
Really?
Right. Now, why am I saying that? So first of all, what did I do? I'm like, Danny, you're stupid. How can you be so superficial?
Right.
You missed on 2 years of an amazing market, right? So I was mad at myself. What I'm trying to say is 1% rule is so superficial that it's really cheating you if you're not doing a full analysis to really know. Because who cares about the 1%? I mean, I don't care about the 1%. I care about the net cash flow, right?
Right. I think that's the most important thing.
Exactly.
And I made the
Exactly.
same mistake, and I lost every penny because I invested in a wrong neighborhood in Cleveland, Ohio as my very first investment.
Exactly.
And
So
I'm
the
like, okay, I'm
1%
not
rule,
doing that anymore.
I've been really advocating to people, don't follow. I have, I talk about it in many instances. Like now, don't use the 1%. It's a rule of thumb, but it's so off, right? It could be so off and misleading. I mean, use it, but you're being superficial. So that's one thing. The second thing that I see a lot, and I think you can also relate to that, especially I because I work with a lot of Silicon Valley type of engineers.
Right, of course.
What do the Silicon Valley type engineers do? They go to the Excel, they go to the screen.
And they compare it against stocks.
Or maybe that too, but real estate is not, on the screen and is not in the Excel.
Right.
We should go to the screen and evaluate. We should go to the Excel and evaluate. But let me give you an example. So I have a deal that I'm evaluating right now of 9 condos in Tampa. Right, Tampa. It's an excellent location.
That's a great market, yeah.
And I've been in Tampa for many years. I just haven't been there for the past 2 because the market is not producing the rents, the cash flow that I'm looking for. But all of a sudden, I come across this deal, 9 condos. For me, for me, bulk deal is great because I have a lot of investors. It's easier for us to come in and buy, I get a package and then I depackage it to individuals. So it's easy for me to approach those deals that the sellers are looking to sell multiple units because I have good ability to depackage them and to my investors. It's with a lease back.
Oh, wow. Okay.
A triple net lease back on a residential unit, which is unheard of.
That's awesome.
The cash flow is amazing. The return are amazing, but there's risk. The risk is who's listing it back. What happens after the lease back is over? There's definitely a risk there. Now, if I am an investor and I'm just looking at the analysis and I'm just looking at the leaseback analysis and it looks amazing, and then I take out the leaseback analysis and just use regular traditional analysis. With the traditional analysis, this property goes from, it generates about $250 negative cash flow a month.
Okay.
Right? Now, as an investor, especially a beginner, but not just even a beginner, I would be concerned.
Right, yeah.
I agree. By the way, I agree. But what investors don't do is like they are like, oh no, wait. Where is the location? How much am I buying though? Maybe we're buying it, maybe we're buying a unit that can appraise for 275 for 230, right? Not the case, but I'm just saying as an example. Maybe there's a way for me to mitigate the concern of the negative cash flow in certain ways. Maybe there's some risk, but a lot of reward upside.
Right.
What I always tell my investors, move away from the screen. Call either the expert, call the boots on the ground, have a conversation, let the boots on the ground tell you what's going on, because you're going to miss on information, critical information, if you're just focused on the Excel. And even the Excel can be, incorrect one way or another, right?
Right.
Because we make a lot of
it's always garbage in, garbage out, right?
Exactly.
That's what you put in.
Absolutely. So I tell investors, I think everybody should, I know not everybody likes doing it, but I'm luckily a little bit old school. I get on the phone and I call my agent. I call, my property manager, say, tell me, what do you think about this deal, this area, this location? I call it, let them sell me the deal. Why? It's not about selling. It's about information. Provide me with the details. When they're selling me, they're telling me the information. right?
Yeah,
So
yeah. They got to sell. They have to provide you real data. They can't just
exactly.
fluff, right? And then, of course, you can decipher, right? You can do further research and make sure what they are telling you is
Exactly.
it's right or
Of
wrong.
course. No doubt, no doubt. But if you're just the point that a mistake that I think a lot of investors are doing, they're looking to Zillow,
Right.
the Zestimate. And I'm not saying don't use the Zestimate. The Zestimate is another indicator. It's not the indicator. It's
Right.
the indicator among others. I look at Zillow too, but I'm not just using Zillow as the
Zillow.
Bible.
Yes,
I'm using
exactly.
Zillow as another. So that's something that I see. And you know what? It comes primarily from the Silicon Valley engineers that are thinking the Excel is set in stone. It's not, and the fact that they don't step out of the screen, Zillow, whatever
Right.
our website, and check with the local PM. Now, as an investor, move away from your computer. Move away. You're hurting
That
yourself, right? You're hurting yourself. I have
that's a great point too. And I was laughing because I could relate to this as well when I started until 2017. That's what I was doing. I'm always okay. Yeah, I got this number. Let me put it in my model. Let me look at Zillow. Okay, this is not a deal for me. I'm done, right? Without doing further due diligence, that if this is really the area or neighborhood I want in, right? So no,
exactly.
I could
Exactly.
relate.
Yeah, exactly.
Hey, so are there any other mistakes you see from investors you want to
I think
highlight?
Yeah, I think that the other thing, besides the 1% rule, be careful of that and moving away from your from the screen and actually doing some quality, evaluation and not just financial analysis. Is I think that most investors, when they start, they sign up with bunch of websites or whatever, and they start getting properties, and that will actually will confuse them more than help them. So I think that it's really important that if you're an investor, if you're a beginner, by the way, not just a beginner, but especially a beginner, take 5 minutes with your coffee this morning or with glass of wine tonight, and just know to ask yourself, I probably have like 10 really important, that if you ask yourself and you know to answer them, it will help you define what path to take. Because once you say, I want to invest in real estate, the world is big. Out of state, in state, residential, commercial,
Right.
low end, high end, short term, long term, right? There's so many, and this is just, I'm just, as you know, I'm scrapping the
Barely
surface.
scraping the surface. Yeah.
Yeah. And so if you're just signing up, you'll get lost.
Yeah.
I think so. But if you ask yourself a few questions, and the good ones, like such as can you get a mortgage? What's your budget? Do you have time? Do you want to be actively involved, or active or passive?
Yeah.
And you know what? One of the most important questions, I think it's critical. Clarify to yourself what are your fears. And when I say clarify, I always tell the people I work with, write it down. Write it down. Only when you write it down, you actually are going to be able to identify it. So what is it? And everything is okay. Like it may be 10 item things or 50. Okay, how will the economy crash? Will it rent? Who will manage? What about vacancy? I get those questions all the time. But if you don't know to identify the concern and the risk, you will have hard time mitigating it. And if you are taking few good minutes to kind of try to figure out what, if the self-assessment kind of a questionnaire will help you clarify, this is the path I should go. And I'm not saying it's my path. I'm just saying it's your path. And there's no right or wrong here. But at least you would know, I'm okay. Maybe you're not okay maybe you're in the Bay Area, in the San Francisco Bay Area, and you are not very excited about going out of state. But guess what? You have $75,000 and ability to get a mortgage to your name. Does it mean the Bay Area really applicable to you? Probably
Right.
not. Probably not. Right. So I'm not saying it's good or bad. I'm saying it doesn't matter. Right. So if you go through those questions, I call it, create yourself the baseline criteria. What are those criteria that will help you define which investment path is right for you, and then stay focused, stay really focused, which is hard, right? You get
Yes.
distracted all the time. It's very hard.
I do too, all the time.
All the
Still,
time.
it's very difficult.
Yeah.
I started focusing on mobile home park and senior housing, and I still see multifamily deal, and I'm like, should I look at it? Self storage, should I look at it? And then I have to tell myself, no, you got to focus on what you
True.
really wanted to get in, right? What you really want to learn, what you really like, right? So define your goals, as you said, define your figure out your fears and your mission as well. What's your end goal, like how. So no, this is great. So let's take a quick break, Danny, and after the break we'll go through the same 5 questions I ask every guest.
No problem.
You're listening to the Wealth Matters Podcast.
The Wealth Matters Podcast.
For more info about what we do, check us out at wealthmatters.com. It's wealth, WEALTH, matters, MATRS.com.
Welcome back to Wealth Matters Podcast. I am talking to Dani Beit regarding some of the most common mistakes investors make, and because he has seen it all, he has worked with tons of investors in past 15 plus years so far. Dani, are you ready for 5 round?
Yeah.
Let's go. Would you be changing any business or investment strategy after this pandemic is over?
No.
So everything is working out.
Working out. The only thing that I see changing is what we talked about earlier. I go after packages more than before, and that's, I think, where I have the advantage there, because I can packages. So that's the only. But I'm still going after the same investment properties, just trying to grab them from packages and individually, but not just individually.
Got it. Favorite real estate or finance or any other related book?
I when I read nowadays, I go after something that will kind of free my mind a little bit from work and real estate. So I can't think of something. I can't even think of a podcast that I listened to and I felt that it's inspiring me. I'm sure there are many of them in our field. The one thing that I can say is, actually is more of a negative about it. Not negative, but instead of recommending what to do, I want to recommend what not to do. At some point, drop the book, drop the podcast, so to speak, and start doing. Start doing. Or move yourself closer, because it's endless books. The more you read, the more confused you will be. I have a really hard time with some of those books and podcasts, because first of all, it's like, I feel it's like 50% mumbo jumbo, not talking about the content, but just fluff to justify the number of pages. And then there's maybe 20% hype, and then there's maybe 30% good content that will be valuable. Yeah. But in order to get to the 30%, I have to sift through so much wasted, energy, and that exhausts me, right? Exhausts me. So, and the same thing with the podcast. A lot of those popular podcasts are simplifying to the point that that it's like, go tomorrow and do it. You know what? Tenacity. You gotta be, you have to go out there and do it and grind a little bit. And I think the best thing you could probably consider is maybe find that either coach or mentor or guide or you know what, even a very good friend. If you are someone who's by himself, find what I call not a business partner as an investment partner. Find a journey partner. You and I will go together. We hold each other accountable. We brainstorm. We calibrate, cross-pollinate each other. And then you will buy your house. I will buy my house. But you know what? At least when I buy my house, you help me look things around and check. And if when you buy your house, I do the same courtesy to you as friends. Anytime I work with 2 people, the success rate of those 2 people increased by tenfold. So find that. If you don't have that friend, there are many mentors out there that can be supplementary to that. But if you can find that friend, one friend, not 2. Don't be a group of 3, only a group of 2, right? And you don't need to buy together. Just go through the journey together. It will help
That's
you
great.
a lot.
Any tool or website you recommend, or you use it every day in your business?
So I have the one tool that it's my I call it, if I don't have it, I feel blind. It's an analysis Excel model that I have put together more than probably about 10 years ago. I've been refining and improving it for the past 10 years. Everybody in our ecosystem uses it. The agents, the property managers don't need it, but the agents and all my investors learn how to use it. It's the one thing, we're all have in common in a tool. It's probably been used more than 50,000 times to evaluate properties, not always purchase, but evaluate. And if I don't have that, I'm blind. And I've done it myself more than 50,000 times, just myself. And I still don't trust myself. I always plug in the number. It's an Excel, but it's a tool that actually it's like a business template. So you plug the numbers, your assumptions, and it gives you the analysis for rental properties, and it actually analyzes rental properties over 30 years. Yeah.
Awesome.
Yeah.
Any advice for beginner investors?
More than what we already talked about here?
Yeah.
Yeah. So I would just say, listen, drop the 1% rule. It's not really a rule. It's more of a, I don't know. Don't trust it. Just, that's one. Two, move away from the screen and actually talk to people, get the quality information. Three, create yourself the baseline criteria, and most importantly, write down your concerns and fears, how many you have. And four, use the right tool or tools to such as the Excel. Make sure you have one to evaluate the type of properties you're buying.
That's great. How do you give back?
Say again?
How do you give back?
You know what? The one promise I did, I did to myself, when someone comes to me and they're on the ground in real estate wise, in trouble, having issues, many times with high stress, I always reach out and help. Always. I've done it many times that people call me out of nowhere and we don't know what to do. We're lost. You can almost hear them crying on the phone. And I just, listen, let me help you. No charge. I'm just going to help you. So I try to bring my experience and skill and help someone who's really in a stressful situation on the real estate side, of course.
Got it. How can my listeners reach out to you?
Well, I would say my online identity is Simply Do It. Can you see it here, right here? I don't know.
Yeah.
Simply Do It. Simply Do It. So my website is simplydoit.net. Our main email is meet, like meeting, but meet, MEET, at simplydoit.net. And I'm pretty much out there on the web, through the website, through different social medias. So, but Simply Do It is probably the most common way to kind of remember and find my name. My name is a little bit more difficult to remember. My last name.
Thank you, Dani.
Thanks for listening to the Wealth Matters podcast. If you enjoyed it, please leave us a 5-star rating on iTunes so others can enjoy the show too. Have a great week and happy investing!